This is Nightly Business Report with Bill Griffith and Sue Herrera.
What a reversal. After falling more than 500 points, the Dow finished higher. Is there a way to protect your portfolio from what feels like never-ending volatility? Jumping ship. There have been a lot of sellers in this market, but it's who's doing the selling that may signal how long this volatility could last. And lessons learned. 10 years since Bernie Madoff confessed to orchestrating the largest Ponzi scheme ever. What has changed? Those stories and much more tonight on Nightly Business Report for this Monday, December the 10th. And we do bid you a good evening, everybody. I'm Bill Griffith. Sue is off tonight. What a reversal indeed. It looked like today was going to be another ugly one for investors for a lot of reasons. There were still trade concerns after a White House official said that March was a hard deadline for talks with China. Apple got caught up in a legal battle with Qualcomm when the Chinese government banned the sale of most iPhone models. And a critical vote on Brexit in the UK Parliament was delayed. It all served to push the Dow down about 500 points at the low of the day. But then Apple suddenly reversed course midday, and that seemed to help lift the tech sector and then the broader market. By the close of another wild day of trading, the Dow finished 34 points higher to 24,423. The Nasdaq added 51, and the S&P 500 was up by 4 points. Mike Santoli takes a look now at this volatile market and what to expect in the days and weeks ahead.
More than 2 months into a nasty downturn, stocks are behaving like some hybrid of a bull and a bear market. The S&P 500 is lower than it was a year ago in its second 10% correction in 10 months, and half of its stocks are down at least 20% from their high. Several potential positive catalysts, the midterm elections, a dovish turn by the Federal Reserve Chairman, a trade truce with China, have not led to any sustained rallies. Safe defensive sectors are the only ones holding up okay. To many traders and investors, this all represents a sign that a bear market might have taken hold. Yet even with all that, the S&P is down only a couple percent for the year and remains up more than 40% since early 2016. And the economic fundamentals continue to suggest no imminent risk of a U.S. recession, with unemployment at 50-year lows, consumer spending solid, and both manufacturing and services sector activity expanding nicely. A recession is usually what prompts a true bear market, often defined as a 20% or greater drop in the broad market indexes. These conflicting signals have investors grasping at prior periods when the market occupied this gray area between bull and bear. Some reach back just a few years to 2015 and early 2016, when we saw two ugly corrections, a global slowdown, an oil crash, and credit market stress, similar to now. Back then, the Fed raised rates in December 2015, its controversial first hike of this cycle. Then the Fed stood pat for a full year as stocks recovered through the Brexit vote and then the U.S. presidential election. It would be a comforting outcome eventually if the market followed that path, but that doesn't make the day-to-day gyrations any less jarring. And of course, no two market cycles match up in every detail. For Nightly Business Report, I'm Mike Santoli.
And those day-to-day gyrations may not let up anytime soon. Hedge fund manager Paul Tudor Jones, who is widely credited with having predicted the market crash of 1987, today said that investors should expect more big moves in the new year.
I think we're going to see a lot more of what we just saw, which is a lot more volatility. It's really easy to say I'm really bullish, I'm really bearish. I kind of see a two-sided market. I think in the next year will be from where we are today, 10 down and 10 up.
He did add that a potential decline in the market could lead the Federal Reserve to hold off on raising interest rates in 2019, and that in turn could boost equity prices. And speaking of which, the Fed funds futures markets, which reflect traders' sentiment about the future rate moves by the Federal Reserve, it's gradually reducing the probability of a December rate increase. It now stands at 68%. That's a 4-month low. The market is also, interestingly, currently pricing in no rate increases for all of next year. That could change, though. As we mentioned at the top of the program, there was disarray in London today when British Prime Minister Theresa May was forced to delay a parliamentary vote on her proposed Brexit deal because of concerns it did not have enough votes. Not only does that create uncertainty for Europe and for Britain's future as part of the European Union, but it further clouds investors' outlook on the global economy. Wilfred Frost reports for us tonight from London.
UK Prime Minister Theresa May called off what had been billed as a make-or-break final vote on her Brexit plan, which was due tomorrow because she feared defeat.
If we went ahead and held the vote tomorrow, the deal would be rejected by a significant margin. We will therefore defer the vote scheduled for tomorrow and not proceed to divide the House at this time.
And she was mocked in Parliament as she explained her reasons why.
I've listened very carefully to what has been said in this chamber and out of it. To what has been said in this chamber and out of it by members from all sides. From listening to those views, it is clear that while there is broad support for many of the key aspects of the deal, on one issue, the Northern Ireland backstop, there remains widespread and deep concern.
She now heads to Europe, hoping for major concessions from European leaders, particularly on that issue of the Irish backstop, something that seems difficult based on this tweet from the President of the European Council, Donald Tusk, who said, quote, "We will not renegotiate the deal, but we are ready to discuss how to facilitate the UK ratification." The British pound had a torrid session off the back of all of this, hitting a 20-month low due to fears of a no-deal disorderly Brexit that could destabilise financial markets and question marks about the Prime Minister's own future. That said, she has salvaged a couple of weeks in order to try to save her deal and with it, her political future. For Nightly Business Report, I'm Wilfred Frost in London.
Now more on Apple, which, as we mentioned, contributed to the volatility we saw in the market today. That stock initially opened sharply lower on word that the sale of some older iPhone models had been banned in China after a court ruled that they violated patents held by Qualcomm, which, as you know, has been locked in patent battles with Apple for several years. Well, Apple responded by saying it did not violate any Qualcomm patents, and this afternoon filed an appeal to overturn that sales ban. That appeared to be when the stock turned higher midday, and it took the rest of the market with it. Meanwhile, in Canada, the chief financial officer of Huawei was back in a Vancouver court today, and lawyers for that executive asked for bail in the U.S. extradition case by arguing that surveillance devices could ensure that she does not flee. And even though it is unrelated to the trade dispute between the U.S. and China, this Huawei case is now contributing to heightened tensions between our two countries, especially in Beijing, where the response has been unusually strong. Eunice Yoon has more for us tonight.
The Chinese government summoned both the U.S. and Canadian ambassadors to lodge Beijing's complaint, calling Huawei CFO Meng Wanzhou's detention vile in nature, extremely nasty, and warned of grave consequences if the CFO is not released. The CFO and her company are under scrutiny by U.S. authorities who claim that the Chinese telecoms gear maker violated U.S. sanctions on Iran through what they described as a Hong Kong shell company called Skycom. The U.S. believes that Meng misrepresented Huawei's influence over Skycom to international banks, putting them at risk for breaching Iranian sanctions. The language out of the Chinese government is unusually strong for an official reaction, highlighting how angry Beijing is about Meng's arrest and why American companies, especially in the tech sector, are worried about a potential blowback on U.S.-China trade talks and on them. The Chinese state media has been describing the CFO's treatment, wearing handcuffs and ankle bracelets, as degrading. Huawei's response, though, has been much more muted, saying, "We have every confidence that the Canadian and U.S. legal systems will reach the right conclusion." For Nightly Business Report, I'm Eunice Yoon in Beijing.
So what a day. From trade to the Fed to concerns overseas, there are a lot of issues contributing to this volatility. Is there a way to protect your portfolio from all of these wild swings? Joining us for a good old-fashioned strategy session tonight, Quint Tatros back with us. He's founder and president of the money management firm Jewel Financial. Quint, good to see you again. Welcome back.
Good to be here, Bill. Thank you.
And we're speaking broadly here. We're not trying to provide specific advice because it varies from individual to individual. But broadly speaking, first thing you say is don't panic sell in this volatility, right?
I think that's exactly right, Bill. For example, today, when we came in, it was a very negative day. think about it, investors had all weekend to think about all the terrible things that are going on in the world. We came out, we were down 500 points, and right when you thought, oh, the worst, is we're kind of coming over this cliff, the market breathed a sigh of relief, and we saw a pretty decent rebound into the bell.
Right.
Our view isn't that we're out of the woods. That's not our view at all. But what we talk to investors about is if they want to take an approach, an active approach to the volatility and reduce exposure, they should have a plan in doing so and not panic sell, but have a plan that as the market recovers, look to reduce the allocation or the exposure when the recovery sets in.
And you say reduce to a target amount. What do you mean? What is that?
So we talk to our clients about a specific allocation when the markets are good, when we're feeling positive about the valuations. And let's say somebody, for example, is a 70-30 allocation, 70% exposed to stocks, 30% to bonds. We adjust that depending on our fundamental or technical view of the market. And so we are currently at about a half of allocation level. So if somebody is typically 100% invested, they're actually about 50% invested right now. And so we are encouraging people to revisit their allocation and find a level that is comfortable for them.
Okay.
Because I agree with Paul Tudor Jones. I do not think that we are out of the woods with volatility. I think that will continue.
I'm going to run out of time here, but this is important. Where do you go then to try and smooth things out or at least find some security? You like gold, for example. What about bonds?
I do like bonds if you can buy the individual paper. Bond funds are going to be difficult because they're going to erode as interest rates go up.
Right.
1, 2, and 3-year Treasury bonds, if you can buy them outright, are, in my opinion, offering good yield and a good place. Utilities and staples are another area that we like here.
All right. Hang on. Buckle up. Do whatever you have to do. Quint Tatro from Jewel Financial. Again, thanks for joining us tonight.
Thank you, Bill.
Time to take a look at some of today's upgrades and downgrades. Now, FedEx was downgraded today to neutral from buy at Bank of America Merrill Lynch, with the analyst citing the management shakeup at its Express unit in the middle of its busiest season. The price target now $220, and the shares fell 4% today to $192.93. Visteon was downgraded to sell from neutral at Goldman Sachs. The analyst there expects the auto parts maker's upcoming business update to be a negative catalyst for that stock. Price target now $63. Visteon shares were down 5% to $64.14. And retailer Five Below was upgraded to buy from hold at Loop Capital. The analyst says that Five Below is more resistant to an economic downturn than most retailers. Price target $120, and shares rose more than 6% today to $101.71. Still ahead, passive investing has become very popular, but what happens when the market turns downward? More international news. There was a dramatic development in Paris today when French President Emmanuel Macron pledged to eliminate that recent controversial tax increase imposed on pensioners, and he proposed to raise the national minimum wage in France come January. Macron's televised address to his nation was in response to the wave of protests that have challenged his authority. They were Macron's first public statements after weeks of demonstrations that turned violent this weekend in Paris. Macron called this an historic time for his country, and he vowed to speed up the tax relief and to restore calm. Meanwhile, the White House has imposed sanctions on 3 North Korean officials, including a top aide to leader Kim Jong-un. The action is aimed at punishing Pyongyang for conducting cyber attacks and abusing human rights. The sanctions freeze assets under U.S. jurisdiction and prohibit transactions with anyone in the United States. And in Japan, prosecutors there have indicted Carlos Ghosn, the former chairman of Nissan. Officials allege that Ghosn violated financial laws by underreporting his compensation. The indictment comes 3 weeks after authorities arrested him. Ghosn, as you know, was once one of the world's most respected automotive executives. Well, the latest market volatility is causing retail investors to grow more cautious and pull their money out of mutual funds. And according to some estimates last week, the 24th consecutive week of fund outflows. And that could have implications, of course, for the broader market. Leslie Picker joins us tonight from New York. How much money are we talking about when you're talking about the mutual fund outflows in recent weeks and months?
Mutual fund outflows in equity-specific mutual funds is over $12 billion last week. Over the course of 24 months, we're looking at over $100 billion, Bill. So this is pretty significant. 24 weeks, for those who don't want to do the math, that's about 6 months worth of outflows, which is pretty significant when you think about what that means for the mutual fund industry as well as what it means for the equity market.
Now, so-called passive investing, index funds, exchange-traded funds, they become very popular at the expense of actively managed funds where you have human beings buying and selling stocks. So when you see them, and they've been very popular during a bull market for the last decade, but what happens when the market heads lower? What is the expectation in the industry for active versus passive investing?
That's a big question that a lot of important people are considering right now, including the Federal Reserve, is what does all of this move toward passive investing mean for the broader market? What we started to see, this is according to market participants, is that index funds, when people redeem from index funds, meaning when they take money out of the index funds are therefore forced to sell assets in an equivalent to the index. So if all of the different stocks in an index are weighted in a certain amount, and people start taking their money out of index funds, those index funds have to sell stocks that kind of mirror an index, so to speak. So there's no real discrepancy in the stocks that they're selling, which makes it really hard for other participants in the market to pick stocks that they believe are poised to prosper because of fundamental reasons. When they look at the balance sheet, when they look at the income statement and other catalysts that they think could help drive the stock higher, it turns out they get punished because people are selling the index funds
their
instead.
hands are pretty much tied at that point. Leslie Picker in New York, thank you. See you later. Elsewhere, Nutrisystem shares are bulking up, and that's where we begin tonight's market focus. The weight management company is being purchased by Tivity Health for just under $1.5 billion. Tivity develops fitness programs for customers aged 50 and older, and Nutrisystem would presumably add nutrition to those programs. Nutrisystem, as you may know, is the parent company of its namesake brand and of the South Beach diet. Shares of Nutrisystem, one of the big gainers today, up 27%, while Tivity Health dropped by 31%. And more than 10,000 Verizon employees have chosen to leave that company by the middle of next year through voluntary buyouts. Verizon has been looking to cut costs as it invests more in its 5G network. The company had about 152,000 total employees at the end of the third quarter. Shares of Verizon rose 1% today to $58.27. Meanwhile, Gilead Sciences will soon have a new CEO. A Roche executive with experience in oncology will take over the top spot of the biotech company in March. One analyst says that move will now make the stock more ownable, as he put it. The stock fell, though, 1% today to $67.49. A major Yelp shareholder is calling for changes at that company's board. SQN Investors says it believes the board has failed to hold itself and management accountable for the company's strategic missteps. Yelp, though, defended its board, calling its directors active and open-minded. Shares rose 3% today to $35.64. And GoPro plans to move production of most cameras that are bound for the U.S. out of China. The company says that decision was made to avoid any new potential tariffs, and the cost of the move will be minimal. In a regulatory filing, the company said production of international bound cameras will remain in China. Stock fell 1% today to $4.92. Now to housing, and because of recent price declines, homeowners are no longer seeing big gains in equity. Some are even losing the ability to pull cash out of their homes. Diana Olick has more.
Homeowners in most places are still making money, but they are now seeing the smallest gains in 2 years. The average homeowner with a mortgage gained $12,400 in home equity between the third quarter of last year and this year, according to CoreLogic. That includes price appreciation and paying down the mortgage. But that's down from $16,000 in annual gains in the second quarter. States in the West saw bigger gains, California and Nevada more than $30,000 on average. Homeowners in North Dakota, Louisiana, and Connecticut lost value. This is all because the gains in home prices are shrinking. Why? Rising mortgage rates, which did drop back in the last month but are still considerably higher than a year ago. We're also seeing more homes come on the market, which has taken the heat out of that strong competition we were seeing. The drop in equity gains has been sharpest in the third quarter of this year. In fact, the amount of tappable equity, which is how much cash homeowners can pull out of their homes, fell quarter to quarter for the first time since the housing recovery began. About 250,000 fewer homeowners actually have any equity to tap now. While most homeowners aren't losing any money, they are feeling less confident about their investment, and that means they're less likely to put more money into their homes and even into the greater economy. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, it's been 10 years since the biggest investment fraud in history was uncovered, and the victims are still picking up the pieces. Here's a look at what to watch for tomorrow. The Producer Price Index will give investors a fresh read on inflation, something the Fed will be watching closely. Google CEO Sundar Pichai is scheduled to testify on Capitol Hill over potential bias in its search results. CBS holds its shareholder meeting after 2 delays in the wake of former CEO Les Moonves stepping down. That should be interesting. It's what we'll be watching for on Tuesday. Meanwhile, the number of job openings has climbed back toward a record. According to the Labor Department, there were more than 7 million positions available in October. That's the second highest level ever. And it means there are now 1 million more job openings than unemployed workers. More evidence of our tight labor market, even as questions continue to arise about the health of the broader economy. And gasoline prices have hit a low for the year. According to AAA, the average national price of a gallon of regular was $2.42. That's 4 cents lower than a week ago, 28 cents lower than a month ago. Fueling that decline is a drop in oil, which fell another 3% today to settle around $51 a barrel. A number of pharmaceutical companies are facing an investigation to alleged price fixing. What began as a lawsuit brought by states into 2 medications in 2016 has now expanded into a government probe involving 16 companies. Investigators claim that those drug makers colluded to keep the prices artificially high for at least 300 different medications. The generic manufacturers have rejected those accusations, though. Shares of several generic makers finished mixed in today's trading. The victims of Bernie Madoff are still picking up the pieces. 10 years after the biggest investment fraud in history was exposed, Madoff, as you remember, confessed to his $65 billion Ponzi scheme a decade ago in the thick of the financial crisis. It fundamentally changed the way we invest, the way investment advisors are regulated, and who we trust. Now, in a new era of volatility, many are wondering, could it happen again? Scott Cohn has our report.
Joyce Greenberg, who invested millions with Madoff, remembers the shock.
I think what he did is despicable.
Eileen Kent says her parents, now in their 90s, lost 3/4 of their net worth.
It was shock, it was disbelief, it was distrust.
The world had seen investment scandals before, but nothing like this. Bernard Madoff was respected, a former chairman of NASDAQ, a sought-after expert on market structure, like at this roundtable a year earlier.
We saw, meaning my brother and myself, that there was an opportunity to bring automation into the over-the-counter marketplace.
But his investment advisory business, with a reported $65 billion under management, was a sham.
I gift-wrapped and delivered the largest Ponzi scheme in history to them, and somehow they couldn't be bothered to conduct a thorough and proper investigation.
The SEC missed all the signals, including from whistleblower Harry Markopolos. Since then, the agency has had a total overhaul.
There are 4,600 people at the SEC. If they don't have it in the front of their mind, they certainly have Madoff in the back of their mind.
The lead prosecutor in the Madoff case, now in private practice, says the whole industry is more careful.
It was an object lesson, both for institutions and for regulators. And hopefully, the passage of 10 years has not led them to lose track of that lesson.
Madoff claimed to have acted alone, but 15 people, including his younger brother Peter, either pleaded guilty or were convicted in the cover-up. 4 people, including Madoff's son Mark, committed suicide. Madoff himself is in the 10th year of a 150-year sentence at a medium-security prison in North Carolina. His former defense attorney stays in touch.
He's doing okay. I mean, for 80 years old.
When we visited in 2013, Madoff told us prison is like being in the Army, only you're not worried about getting killed. Much less stressful than his life of crime.
He's leading a lot better life than many of the victims are.
As for those victims, it's complicated. On average, they're getting back about 75% of their principal, unheard of in a typical Ponzi scheme. But investors who took out more than they invested, like Eileen Kent's parents, are lucky to get anything at all. That's because courts have ruled the returns the investors thought they had earned, some $50 billion in all, were nothing but Bernie Madoff's cruel fiction. For Nightly Business Report, I'm Scott Cohn.
All right, before we go, a final look at the day on Wall Street. And these numbers don't tell the whole story, as you've heard by now. The Dow closing up 34 points, but it had been down as many as 500 points at the lows of the day. The NASDAQ added 51. The S&P was up 4. What a day. That's Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching, everybody. Have a great evening. We'll see you tomorrow.